Well, good afternoon, everyone, from beautiful downtown St. Louis, Missouri. Started out with some rain out there this morning. It's starting to clear up a little bit for us. Still a couple clouds out there, but a beautiful day nonetheless. And I can tell you myself, I'm excited to have you all joining us this morning. My name is Dave Finklang, and on behalf of all my partners and all of our colleagues here at Anders CPAs and Advisors, excited to have you this afternoon for the 5th installment of our webinar series on the CARES Act. So before we get going, I would like to thank each of you for joining us today. We do know that all of you are being pulled in, quite frankly, a million different directions right now, whether it's working from home, teaching the kiddos, juggling back and forth between remote offices, and now as some offices and businesses are starting to open up as the country gradually opens up, you're back and forth between your business. So thanks for spending an hour with us today. We promise we'll make this a hopeful, very valuable use of your time. So for those of you that have joined us before, we might cover a few topics that you've heard us speak about before related to loan forgiveness. That's going to be kind of a refresher for all of you, but for those of you that are joining us the first time, hopefully that'll be new information and valuable information for you. So we are going to spend a few minutes with a little refresher course, if you will, but we do want to spend the majority of our time today really giving you some insights that we've learned the past week or week and a half since the SBA has released their loan forgiveness application, which, par for the course for the government. We're 6-7 weeks into a new program, and we finally get some documents that we've needed. So we're oddly excited to have paperwork from the SBA there. Once we review that application or some of the key parts of the application and key things we've learned, we are going to give you some updates on some other CARES Act and stimulus programs towards the end. But we do want to focus the most of our time today on the loan forgiveness and some of the key things we've learned there, because we know that is, the most valuable thing right now. So our presenters today, several panelists that you might recognize, my colleague Dan Schindler and Paul Ray. They've been on several of our webinars, as is my colleague Dan Mudd in the bottom corner there. We've also welcoming to the panel today our colleagues Chad Gall and Rebecca Tucker. Behind the scenes are our Wizards of Oz, behind the curtain, as I like to call them, answering all of your Q&A as you type them in. We've added a few folks this time because the Q&A does tend to fly fast and furious. So behind the scenes, you'll have Luke, Jane, Lori, and Abigail tackling all your questions. So the last thing before we jump into the content, I do want to let everybody know we are recording this, just a little housekeeping there. So a few hours after the webinar, we will be sending this out to everybody that's registered today. And then we will get our Q&A from today downloaded and cleaned up a bit and have that out on our website for you as well. So with that, let's jump right into the content. So a little refresher again, but for Dan Schindler, Dan, can you talk us through the key criteria in order to achieve loan forgiveness for PPP loans?
Sure. Thanks, Dave. Thanks everyone for joining. The information we discussed today are the rules as of today, which may change tomorrow. They may not. You never know at this point. We'll discuss things in more detail as we move along, but in general, to achieve the maximum loan forgiveness, there's a couple criteria you need to keep in mind. The first is use your PPP loan funds on eligible expenses within your 8-week covered period. There's also the 75%, 25% rule, 75% towards payroll costs. The remaining 25% can be used for other non-payroll costs that we'll dive into further. The 75% payroll costs is a minimum amount. You can use 100% of your PPP loan on payroll costs, but it just must be a minimum of 75% of your loan forgiveness amount, not your loan proceeds, your loan forgiveness amount. And then lastly, there's also a couple full-time equivalent and wage thresholds that we'll dive deeper into, but those thresholds must be maintained in order to achieve maximum loan forgiveness.
All right, thank you, Dan. So since there are multiple costs involved in this, Dan Mudd, could you go a little more into detail on the approved costs that you can use your PPP funds on?
Yes, thanks, Dave. So there's 4 main buckets that you need to use your monies on. Of course, the biggest one is the payroll bucket. And there had been a lot gray areas related to almost every one of the 4 buckets that have mostly been cleared up to this date, which has been nice. But payroll's the main bucket. As Schindler said, 75% of your proceeds should be used for payroll. And then rent and lease costs, as long as that contract was entered into before February 15th. Utilities, and then interest on some debt. And we say some debt because the debt needs to be backed by real estate or personal property. So there is also a laundry list of things that come under utilities, some of which you may not be familiar with or think about as a utility. But we have a list on our website of the details of every one of these main buckets. So I encourage you to go to our website, anderscpa.com, and look at our COVID-19 Resource Center for more details on those 4 buckets.
Yeah, thank you, Dan. And again, just for those that have been with us before, and honestly for the new folks, we're going through these first few questions pretty quickly just because they're somewhat of a refresher. So hopefully some of you have seen these before, the goal being to really get into details. So again, if you have questions on any of these, we'll address them in the Q&A, but also on our COVID-19 Resource Center. There's prior webinars and a lot of information out there about these. So Dan, since payroll is such a key component of the PPP program, and this is where a lot of questions come in, can you please go through the payroll costs that are not included in the PPP program or not eligible?
Sure, thanks, Dave. Federal employer taxes that are matched, FICA taxes are not included. Wages above 100,000 are not included. And that's, so if you pay an employee, whatever you pay them during that 8-week period, if you annualize that amount, any amount over 100,000 would be excluded. Sick and family leave covered by the Family First Coronavirus Response Act. Workers' comp fees, expense reimbursements, fringe benefits, and some other benefits. So there is more information on our website about those, but those are the main ones that would not be included.
All right, thank you, Dan. And we'll get a little more into detail on one specific question we've gotten a lot, which is owner compensation, a little bit down the presentation. So Dan Schindler, going to hand it back over to you because we've talked about costs that are included or are eligible, but there's a lot in the PPP program related to maintaining wages, maintaining full-time equivalents. So can you talk us through the wage test and what that means for forgiveness?
Sure. So in general, the crux of it is to achieve the maximum loan forgiveness, you cannot reduce employees' wages more than 25% compared to the most recent full quarter. So you cannot reduce someone's wages more than 25% compared to the first quarter of 2020. Now, this is looked at on a per employee basis rather than in the aggregate. I want to highlight something here in the first bullet point. This rule is only applicable to those that made less than $100,000 annualized for each pay period in 2019. So if someone were to have received a rather significant bonus in the first quarter of 2020, even though their base comp, say, is $90,000, if they happen to receive, say, a $10,000 bonus in the first quarter of 2020, that pay period, or sorry, in 2019, I'm sorry, in 2019, if they received a $10,000 bonus in any pay period of 2019, that would not make, that would exclude them from this wage level calculation because it is annualized $100,000 for each pay period in 2019. For anyone who makes over $100,000 annualized in any of those pay periods, they will not be considered for this wage reduction calculation.
All right, thanks, Dan. And quite frankly, just moving right along, wage levels are critically important to the PPP forgiveness, as are your full-time equivalent. So can you please talk through the full-time equivalent test?
Right, so similar to the wage reduction, there's if your full-time employment or your full-time equivalent level is reduced during your 8-week covered period, your loan forgiveness may be reduced by the percentage reduction in full-time equivalents that we'll go through in a little bit more detail coming along. So the loan application or the forgiveness application was released about a week ago, and in there offered 2 covered periods. One is the typical covered period, which begins on the date loan proceeds were received or the loan disbursement date. Then it also offered an alternative covered period. So for those that have a weekly or bi-weekly payroll, you can use the alternative covered period, which begins on the first day of the first pay period following the loan disbursement date. So it essentially aligns your covered period with your payroll periods. Go ahead.
Oh, you can keep going, Dan.
The full-time equivalence, which was once thought to be 30 hours due to the Affordable Cares Act, is now actually 40 hours to define a full-time equivalent. The full-time equivalent can also be calculated in one of two ways. You have to calculate your full-time equivalence on a per employee basis rather than in the aggregate. You would take the total hours per employee for a given week and divide it by 40, rounded to the nearest tenth. Sum up the totals for each of those employees to determine your total full-time equivalence. Alternatively, there is a simplified method to calculate your full-time equivalence, which is anyone who works 40 hours or more is considered one full-time equivalent. Anyone who works less than 40 hours is considered half of a full-time equivalent. It would be more advantageous to do the alternative or the simplified method if you have a handful of employees that work more than 20 hours but less than 40 hours. So they would be considered a half of an FTE at that point rather than 0.6, 0.7, 0.8, or so on full-time equivalent. You must maintain the average full-time equivalence during the 8-week period that is equal to or greater than the base period you choose, which is here on the screen, February 15th of 19 through June 30th of 19, and January 1st of 2020 to February 29th of 2020. You want to look at your average full-time equivalence during those periods and take the one that benefits you most, i.e. the lesser of those two periods, and compare the average full-time equivalence during your 8-week covered period to this base period.
Wow. Need a glass of water after that one, Dan?
No one said it was easy. This whole program is more complicated than I think anyone ever imagined, but that's the crux of it. From a simplified standpoint, it doesn't get extremely simple.
Right, and considering you just talked for about 27 minutes on one of the most complicated parts of this program, and I'm a CPA and liken myself to be pretty good with numbers, my head's spinning. Could you offer our friends on the webinar a little help here on how they can handle all this?
So if we want to go to the next slide here, well, I guess first, the payroll companies should be and are getting very, very helpful in this regard. Everyone and their brother is asking their payroll company to develop some sort of report that helps them calculate their full-time equivalence. So you can certainly come out to us for help in calculating your FTEs. I suspect most payroll companies are developing their own internal report to give to their clients because they're getting this question from every single one of their clients as well. We've also put together this full-time equivalent calculator here that's on the screen that once you've kind of calculated your full-time equivalence for each of the base periods and your covered period, our FTE calculator on our website is formula driven to help you identify what amounts of average full-time equivalents you need to obtain during your 8-week period compared to a base period. Dave, anyone chime in to simplify things, but that's without going into an hour-long presentation on this, trying to keep it as high level as possible. That's the basics, I guess.
Yeah, Dan, you definitely took the bait there. So thanks for walking folks through the fact that their payroll companies are really doing a nice job of putting together these different reports for full-time equivalents, and then also out on our COVID-19 Resource Center, we do have the full-time equivalent calculator to assist as well. So to give Mr. Schindler a break to grab some water and a snack after that dissertation, I'm going to ask Mr. Mudd a question. So Dan Schindler talked us through these wage tests and the full-time equivalent tests. We're seeing a lot of businesses start to reopen, but not all businesses are back at their full wage base or their full-time equivalent base. So are there any things written into the CARES Act or the PPP program that they should be aware of in terms of, like I've been liking to call them the get out of jail free cards. Is there anything they can do if they're low on wages or low on full-time equivalents?
Yeah, thanks, Dave. Yes, there's a lot that you can do. The biggest one that I know of is sort of what Dan Schindler alluded to, is you need to know in advance before things happen. You have to plan things out ahead. You have to use all these little tools and resources so you can, monitor what your numbers are, because you've got so many different things that you're tracking: full-time equivalents, dollar amounts per employee. So you just need to know if you're falling short or not. And if you are, and one of your goals is to maximize loan forgiveness, then you have to come back to your calculator and see what you need to do to increase your numbers to maximize your loan forgiveness. So before I talk about the first point, I want to remind everybody that everybody's 8-week period is different. I mean, depending on when you applied for your loan and or when you got funded on your loan, your 8-week period is different. When they originally put this June 30 date out there, this was early on before the program even opened. And I think that they were thinking that by June 30th, you'd be at the tail end of your 8-week period, and that might be your last payroll. So it is built in there that if you fell short for your FTE count, that you can catch it up. And as long as they're included on the June 30 payroll, then you'll be whole and you won't have a reduction in your loan forgiveness. Again, though, everybody has a different 8-week period. And then again, to maximize your loan forgiveness, you do have to use your proceeds during the 8-week period. There are 1 or 2 exceptions where you can have payroll that's incurred in that 8-week period, but it's paid shortly thereafter. And that's on the front and the back end. We've got more details out there on our website to explain that.
Thank you, Dan. And whether you intended to do that or not, a perfect segue into my next question, which we'll hand back over to Dan Schindler. And this is going to, I think, clear up a question or two that I've seen pop up in our live Q&A, which is, how do we handle costs that are paid quarterly or annually that might not fall exactly in the 8 weeks? And then kind of similar to that, how do we handle costs that were incurred prior to the 8 weeks, paid during the 8 weeks, or possibly even incurred in the 8 weeks and paid after the 8 weeks? So a couple of different scenarios. So can you please talk us through those, Dan?
Right. So in regards to this topic, the guidance that was released kind of gave borrowers the best of both worlds, so to speak. For payroll costs, you get to include wages both paid and incurred during the covered period, both paid and incurred. It is considered paid on the day that paychecks are distributed or when the borrower originates an ACH transaction. Payroll wages are considered to be incurred on the day that the employee's pay is earned. These are eligible for forgiveness. The latter here, the wages that are incurred on the day the employees earn it, but paid after the fact, after your 8-week covered period, those are still eligible for loan forgiveness. Similarly, on the front end, if today you get your loan proceeds and today's the first week of your covered period, and you also have a payroll that is today that covers a period prior to today, it covers the last 2 weeks or so, the wages paid today are included and eligible for forgiveness. So that's a cash basis essentially here. On the back end, it is accrual basis, where if the employee earns it during the 8-week period but is paid outside of the 8-week period, it is still eligible for forgiveness. For non-payroll costs, the non-payroll costs must be paid during the covered period or incurred during the covered period, and just pay, and those will be eligible for forgiveness as long as they're paid by the next regular billing date. So if we're looking at the end of the 8-week period here, and you get your utility bill, a week later that covers the most recent month, well, that would be eligible for forgiveness if it was paid by its next normal billing date or pay date.
Thanks, Dan. And that was something that was, up until the forgiveness application came out, was pretty uncertain and well, quite frankly, unclear. So that's one thing when the forgiveness application did come out that really clarified a lot of things for us. So thank you, Dan, for that.
And I will say, for the retirement plan contributions and health insurance, employer health insurance plan contributions, It's our interpretation right now that if those costs are paid annually or semi-annually, quarterly, or anything of that nature, those costs must be paid during the covered period to qualify.
All right. Thanks for that clarification, Dan. I think that's an important one to point out as well. So another one for you, and this I think will answer a few questions we see popping up in the live Q&A, and has been a very popular set of questions from business owners themselves, is can business owners be paid with PPP funds and have those eligible forgiveness? If so, how does that work for the different type of entity structures that a business could potentially have?
Certainly, business owners need to be compensated for all their work as well, and their compensation is eligible for loan forgiveness with certain restrictions and limitations. If your entity type is a C Corp or S Corporation, generally the owner should be on payroll, normal payroll, receiving a W-2. In that case, continue paying that owner via W-2 and normal payroll. For multi-member LLCs, partnerships, the Treasury and the SBA use a term called owner compensation replacement. And for partners in a partnership, they would be, their owner compensation replacement would be based upon their net self-employment income. So partners in a partnership receive a K-1. In box 14A, it shows an individual partner's net self-employment income. And that is what is used to determine the amount of owner compensation replacement. The partners in a partnership or members in an LLC can be paid via distributions, guaranteed payments, however they have generally been paid in the past. Continue that method of payment. Single member LLCs, sole proprietorships, those who report their income and expenses on a Schedule C also use a similar term called owner compensation replacement. That owner compensation replacement is based upon the 2019 net Schedule C. And similar, what I forgot to mention previously, partners in a partnership or members in an LLC, their owner compensation replacement is also based on their 2019 net self-employment income. So regardless of the entity structure here, business owners cannot receive any more compensation than 850 seconds of what they were paid in 2019. That 850 seconds is 8 weeks for the covered period divided by 52 weeks in the year. That's where that 850 seconds comes from. So you have to look at the business owner's compensation, whether it's on W-2 wages, whether it's net self-employment income on a K-1, or whether it is your net Schedule C. Your amount eligible for forgiveness cannot exceed 850 seconds of what you earned in 2019.
Dan, that's a really good point. Your last point especially. It's key to point out that business owners can and should be paying themselves with PPP funds, but very important to keep in mind the limits on looking back at 2019 to make sure you're not effectively overpaying yourself. And if you do overpay yourself, it's not necessarily going to cause any red flags in terms of, I don't think, particularly trouble with the SBA or trouble with the IRS, but it will impact your loan forgiveness if you pay yourself more than the limit. So
that's exactly right, Dave. That's a good point. There's nothing that says, you cannot continue paying the owner what they have always been paid. If it's more than $100,000, whatever it may be, the limits here are only on the forgiveness amount, not what you can actually pay the owner.
Right, and that's the point I wanted to drive home there, just to make sure people don't freak out too much there if that caught them by surprise. And quite frankly, when the forgiveness application came out, that caught us by surprise a little bit, because I don't think anybody was really expecting it. But that's been par for the course the past 8 weeks. The rules change every day, it seems like. So next question for Dan Mudd. We've gotten this question in various different forms and various different ways, but effectively, can we include, if we need to increase pay, can we include employee bonuses, vacation, raises, those type of increases to employee pay in the 8 weeks?
Thanks, Dave. Yeah, there's been a lot of discussion early on about this type of stuff, because if you think back, it's called the Paycheck Protection Program loan. It was literally to pay employees that weren't actually at work due to the lockdown. So people have been scrambling to try to figure out what all this has meant. The term bonuses have been used, hazard pay has been used, retention pay has been used. So yes, as long as you're operating within the parameters and the guidelines with the SBA, you certainly can pay bonuses and pay people for retention and or hazard pay for asking them to work at home while they're also homeschooling their kids and the daycares are shut down. So you still have your limitations on the $100,000 per year annualized during the 8-week period. And it just, if you think about it, when they originally applied for the loan, they applied for the loan for 2.5 months of payroll, but they only have 8 weeks to pay the payroll. So there's this little bitty math miscalculation between those two things. But yes, it's certainly okay to pay a bonus, to pay retention, to pay some hazard pay. If your goal is to maximize your loan forgiveness, you have to pay it in the 8-week period to even be eligible for maximizing your loan forgiveness. So there are some people that are optimizing between loan forgiveness and then hanging on to some of those proceeds after the 8-week period, knowing that they're going to have to pay it back, but only at a 1% loan. If you do choose that, you still have to use that money for those 4 main buckets that we mentioned earlier: rent, utilities, interest, and forgot the other one. But anyway, you still have, there's no getting around the fact that you have to use it for those 4 buckets.
Right. And I think, Dan, the key thing I've kind of kept reminding myself in this particular area related to bonuses and vacation and raises is that we have to make sure we go back to that incurred and paid concept. We have to make sure whatever we're paying them in that 8 weeks was actually earned in the 8 weeks. So we can't really, we want to make sure we're not prepaying any bonuses, prepaying anything. But if it was a legitimate bonus earned in the period for, again, the stressful work environment or going above and beyond kind of the call of duty, those can definitely be paid in that period. Right. And since you alluded to it, I know it's one of your favorite topics to talk about internally here at the firm, as well as with our clients, is what can you be doing now, or what should you be doing to maximize your loan forgiveness?
Right. So we've come up with a few calculators. If you can go to the next slide. We've come up with a few calculators to make life easy. There's a loan forgiveness estimator that we've got out on our website, and it's a fillable format, and you can download that, use that, or you can have us use it as well. I don't see it up on my screen right now for some reason. There it is. So we've got the FTE calculator and we got the loan forgiveness calculator. The whole goal with using these calculators is to know in advance what's going to happen before the 8-week period is over. You can't wait until after your 8 weeks to try to then calculate it yourself and realize you left some money on the table and now you do owe it back, whereas you could have given it to some of your employees that have, we've all been through this difficult time. So use the calculators. Plan in advance, fill them out, and if you're falling short, that's where you got to kind of go back to the start and say, what else can I do to maximize my loan forgiveness? And the calculator should do some of the math for you, but you certainly have to double check it and make sure you have everything input correctly.
Dan, I think what you're talking about is key for those on the webinar today if you haven't done that yet. But that is really so many decisions we make as business owners. We're always forward looking. This should be one of those times as well where we're putting kind of our smart business owner hat on and projecting our spend out for the next couple of weeks, depending on how far into the loan you are, and depending on where you're coming up. If you're falling up a little short, that's when we make that decision. Do I maybe pay some bonuses? Do I give some raises for this 8-week period? Do I make the decision of, well, maybe I'm okay with a 1% loan for 2 years, and maybe I let some of that money carry me for the next 8 weeks? The critical thing that Dan mentioned, and I'll remind you, is that just because we're okay with having a loan, we still have to use the loan proceeds on those 4 eligible expense buckets. You still have to use it on payroll, rent, utilities, and interest. We can't just use the money on something else if we decide to have the loan. We still have to use it on approved expenses. So I think this might be the last one for you, Dan Schindler. But I know this is a topic that got cleared up in the application a little bit. But we've gotten this type of question a whole bunch of different ways over the past couple weeks, and that is, what happens if I have employees that don't want to come back for any reason? I've offered them a job, they've turned me down. What if I was going to terminate somebody for poor performance before COVID happened, and now I still need to let them go? There's all these various scenarios of why employees might not come back, or why we would invite them not to come back. How does the PPP program now address those situations?
Right. So these were addressed due to employers having a difficult time maintaining their full-time equivalent thresholds or maintaining their wage thresholds. So employers ran into situations that were preventing them from getting their full-time equivalent level back to where it needed to be. So there's a couple exceptions that help borrowers in this FTE calculation. And if one of these exceptions are met, the particular employee may be removed from their base period FTE calculation. And these exceptions give a benefit to employers struggling to get those employees back due to various reasons. One of the main ones that I've seen of late is the increased unemployment benefit. Some people are making maybe more on unemployment than they were by actually working, and whether right, wrong, or indifferent, they don't want, the Treasury and SBA is not trying to ding employers for their employees not coming back. So one of the exceptions here is if you have a good faith written offer to rehire an employee during the covered period which was rejected. In that instance, they will be removed from your base period FTE calculation. Now, you must offer the same salary if it's a salaried employee, or for an hourly employee, you must offer them the same number of hours and same hourly rate as they were before. Or if we want to go to the next slide, the other exception is, as Dave alluded to earlier, is if any employee is fired for cause or voluntarily resigned or just requested and received a reduction in hours. The employer will not be dinged in those instances. Now, if you fire someone for cause, make sure the cause is real. Make sure it's documented. You don't want anything other ramifications due to firing someone for cause. So be cautious of that. But if it's a true fired for cause case, then you will be able to remove that employee or their full-time equivalent from your base period FTE calculation.
Dan, I know everything you just ran through was I think, quite frankly, for a lot of business owners, very good news. Not that we don't want our employees to come back, not that we're all running out to let employees go, but in those situations where folks didn't want to come back and where somebody maybe shouldn't have been asked back for just cause, now we've got a few safe harbors, if you will, in the application that allows us to not jeopardize our loan forgiveness because of that. So far, we've been really focused on loan forgiveness. We have a lot of live Q&A questions come in. Definitely keep those coming. We're going to answer those as quickly as we possibly can. You can always follow up with us after the webinar as well. The next topic we want to cover is, we've talked a lot about loan forgiveness. Now let's actually talk a little bit about the loan forgiveness application itself. Some of the key forms, some of the key pages, some of the key language. So for that, we're going to ask our resident banking expert, Paul. Paul, can you first talk us through the responsibilities of the business owner or the borrower related to that forgiveness application that came out about a week and a half ago? And Paul, you may be on mute and your video may be off. You sleeping on the job over there, buddy?
No, I'm right here. My video shows I'm on. How about my microphone?
There you go. Oh, look at that haircut. You look like
okay
a fresh
now?
Paul.
I knew we would interject a little levity, and I always get very nervous when Dave introduced me as the resident banking expert. I'm not sure if that's a compliment or not, but let me dive into the application a little bit. One of the things I wanted to make sure that we do is going to give you some directions out there with this wonderful 11-page document that's been out for a couple of weeks now. You can go to ustreasury.gov. There is the link to the application there. We also have a link to the application on our website. It's something I would encourage you to go out. Obviously, if we spent time today walking through all 11 pages, we would be here for 4 hours, and none of us want to do that. What I want to do today is sort of highlight some things over the next 3 slides that I think are important, and these come directly out of the IFR, which is the interim final ruling, which always in itself seems a little funny, but that was released on Friday, the 22nd. So we want to kind of move through and give you an idea of where you need to go from here. So it addresses 3 key things. One, what are the responsibilities of the borrower? So, number one, on page 3 of that 11-page application, and as I said, I would encourage you to take a look at that after the webinar and not specifically try to go through and look at all of those now. Plenty of time for that later. But page 3 will be key. As a borrower, I'm going to really only send a certain amount of things to the bank. So I'm going to send the PPP loan forgiveness calculation form, page 3. That's going to go on top if we're trying to create this nice, neat little packet. Then there's a PPP representation and certification form. That's page 4. And really what that is your certifications as a borrower that you've played by the rules, that you've done everything right. The third document that you're going to provide to your banker is the PPP Schedule A, and that's page 6. Schedule A is where you do all your calculations. You're going to calculate the FTE. You're going to calculate wages. You're going to calculate the things that you've expended, the 75 versus 25, payroll versus additional. So that obviously is a very important document. That's document number 3. With that, when we talk about this 11-page document, most of this 11-page document is instructions or as sample tables that you can use to get to these numbers that you're going to plug in these 3 to 4 documents that are on top. So those are things you will keep in your possession, but these are the 3, at least 3 of the first 4 that you're going to provide to the bank. So let's move to the next slide if we could, please. So the last physical document that's not supporting documentation is on page 11, and that's a PPP borrower demographic information form. If you've ever went out and applied for a mortgage, you know that they ask you voluntarily to provide demographic information. This form is no different. It is optional. You don't have to provide it, but it's there certainly if you want to, and that helps the government sort of track and understand all of the information that they need in future projects. So you've got these nice 4 pages here. What do we do next? Well, page 10 of this application is going to really let you know all of the supporting documentation that you need to provide to your lender. So it will walk through there. 3/4 of that page will walk through the things that you need to go along with these initial application forms. The bottom part of that page literally tells you what you don't need to give to them. And that's a lot of things that are helpful to you. There are different, as I said, different tables. You may have other documentation that answered the questions instead of using those tables, but those are all worksheets. So it will tell you what to provide your banker and what not to provide your banker. And I think if there are bankers on the phone, they would tell you that in this particular case, that it's best to provide what you're asked, no more and no less. You know, from a perspective of being a former banker, we always want a ton of information to underwrite an application, to get everything that we can to understand a loan. Well, here, you know, there's a lot of things that the bank just doesn't need, and more of that information is probably not going to assist them in their process. But the one thing that is most important, and this hasn't changed from day one, is that you as a borrower bear the full responsibility of providing complete and accurate information to the bank so that they can do what they need to do to move it on to the SBA. And I will cover that on the next slide in just a little bit more detail. But I always want to make sure that we come back and understand that is you as a borrower who is accepting that responsibility, and you're certifying that in those documents. So next slide, please. So the IFR that came out clearly states thought that, you know, the banker would just sort of package everything up, including all that supporting information, and send it on. And certainly over the process here, I think most folks have figured out that, you know, the bank will obviously stay involved. But remember, I'm going to go back to that statement earlier about it being your responsibility, because the banker is going to take the information provided. And in the second point here, the banker only really needs to do a good faith and cursory review of your supporting documents. Because this isn't a loan that they've underwritten, that they're keeping on their books, they will do a good faith cursory review. Whether, I'm not sure how banks that are using electronic portals or individual banks, all of that sort of has to be figured out at this point. But they're going to take a cursory review of this information. It's not their job to go through, nor could they ever go through all of that documentation and make sure that it's 100% correct. They're going to do what they're asked about, you know, checking off sort of boxes saying, yep, we had this, 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 and this. And then they're going to move a particular document, actually 3, onto the SBA. So let's go to the next slide here. So the lender is going to send 3 documents to the SBA. They may send a cover sheet with that. The SBA between now and the end may ask for additional documentation. They also can come back and ask for additional documentation during a review. But according to IFR, the actual calculator with your certifications, the PPP schedule, the Schedule A that we listed, then your optional borrower demographic form, that's going to go to the SBA with whatever cover documentation that they have. All of your supporting documentation will remain with the bank, and obviously you should have copies of that as well. So they will recommend approval, denial, or there's another term in the previous slide, you don't need to go back, but it talks about denying it without prejudice. And what that basically is saying is the SBA then has the opportunity to review whether they're asked to or they select that on their own. But again, the banker will make that recommendation. Ultimately, the SBA then will come back to them based on the information that they've sent and either agree with it or not agree with it. So bullet point number 2, the SBA can ask to review any size application. The lenders and borrowers are required to keep supporting documentation for up to 6 years, and that's all specifically in that IFR. That's not opinions by Anders or other firms. Those are specific requirements. So I kind of think it lends to the fact that there's going to be a long time that the SBA could come back and review the documentation. They're not reviewing it based on the 2 million over or under. That was about your accountability and your ability to get the loan. This is about forgiveness. So they can come back and ask for all of that documentation that the bank has. The bank would respond to them with that and review for accuracy and those types of things. But again, remember, the bank just will take an initial cursory review. So let's go to the third important point that come out of the IFR on last Friday. And it talks about the timing of forgiveness. So if we think about it, we know our borrower's responsibilities, we know our lender's responsibilities. So what does that look like from a timing perspective? So I would encourage you, and I'm sure people have already been doing that, pull that 11-page document off there, read the instructions, sort of get prepared for that. But your lender should and will inform you when you may start to submit the forgiveness application. If you think about it, got to get things paid for. If folks need that safe harbor, you've got to get to June 30th. So there's still some time to go through that process, and there's still time to wait for more SBA clarification. We know that's coming. But your lender will let you know. I wouldn't rush to my lender now with a bunch of information. There's nothing they can do with it at this point. They're going to issue a recommendation, the decision on their decision to the SBA no later than 60 days after receipt of complete application from the borrower. So I highlighted the word complete. So to remember, if you kind of take it in and half of it's done, that just doesn't count. It doesn't start the clock. So you'll need to make sure that it's as complete as you can get it to the bank. Then they'll have 60 days to do their cursory review. Anything else, if you think about the volume that bankers are going to have to look at, I don't expect they're going to need a lot of time looking at each. It's just the sheer volumes that they're going to get as soon as the window opens up. then the SBA has another 90 days that they can render their confirmation. So if you think about that, that potentially could be a 5-month period. Whether it happens or not sure. I think that all tells us why that originally in the very beginning, the SBA said we're going to give a 6-month window before people start have to paying if these become loans. It's going to take close to that long to get through this process. And we'll see. The banks obviously have streamlined some things. Once they get it in the hands of the SBA, then there's nothing else they can do about it until the SBA comes back to them. And then the last bullet point on the application piece is, again, there's always that clause out there, and it clearly says that in the IFR. There's still going to be further guidance forthcoming on any sort of appeal processes by the borrower. You will have an opportunity to appeal. It lists a 30-day time frame in there that you can appeal. If your banker denies that, you have an appeal process. If the SBA actually denies it for whatever reason as well, you do have an appeal process. So that's why it's important to make sure that you're keeping those records. So responsibility of borrowers, responsibility of lenders, and certainly timing. Those were kind of the key areas that the IFR talked about. Much more to get into, but I would encourage you to go out, print off that particular form, go through it and read it. As confusing as it may seem when you start to read through it, I think it will help you understand that there is a method of some of this madness, and hopefully there will be a little more clarification. So at this point, I think we're on to the next slide, correct, Dave?
Yeah, Paul, I think I think you did a nice job with your dissertation there. And the thing that I've taken away from this entire process, be it that upfront application where we actually applied for our loan, or now on the back end with this loan forgiveness application, being as diligent as possible with our record keeping now and as diligent as possible with our expense tracking now is going to set us up for, number one, the most efficient process to complete that application on the back end. And then the more thorough, more complete, more organized our packet is for the bank, just in theory, the quicker the process should go and the quicker we should fly through the system. The last thing you want to happen is have your loan forgiveness application get bounced back to you and have to do the back and forth game. So all those things we've been talking about this entire time, record keeping, documentation, expense tracking, couldn't be more important when it comes to this application. So thank you, Paul, for the thorough review there. We're going to switch gears just a little bit here as we get towards the end of our hour together. One of the things that kind of got swept under the rug a little bit early by the IRS when they released it, but Congress called them out pretty quick, and quite frankly, a lot of people called them out, was the IRS did change the game a little bit when it comes to the loan proceeds and tax deductibility and how we have to look at this now. So for that, we're going to hand it over to Rebecca. Rebecca, could you please talk us through how the loan proceeds and deductions are going to go now under the IRS change of about a couple weeks ago?
Absolutely. Thanks, Dave. So I think we should start with when the CARES Act came out and what we knew then. At that point, the CARES Act specified that any loan proceeds that were forgiven would be non-taxable. So that meant that unlike any other forgiven loan, the income that we received from PPP program is not going to be taxable. So this is a huge benefit. At the time of when we just had the CARES Act before April 30th, there was no effect to the deductibility of the expenses paid with the PPP loan proceeds. So then on April 30th, what happened? We got an IRS notice that kind of challenged the perspective of the CARES Act. Basically gave us the information that any expenses paid with the PPP loan proceeds are not going to be deductible for tax purposes. So, that we can't really state an opinion here about comparing it to what the CARES Act stated. It's not necessarily in line with that. So there are some challenges in Congress that are pushing back on this IRS notice that are debating whether or not that's fair and equitable. So stay tuned, that may change in the near future. But what we need to do now is looking at the guidance that we have currently. So we need to be looking at projections for year end and cash flow and see where we may land now that we know that these expenses are going to be non-deductible. So let's walk through a brief example. say that a business received PPP proceeds of $500,000. They used those expenses, say $400,000 for payroll, and the remaining $100,000 was for other qualified expenses. So for all sakes and purposes, we're going to say that this loan is forgivable. Now that $500,000 of expenses that we paid that would normally be included as a deduction for taxable income are going to increase our taxable income by $500,000. If we take that, for example, times the corporate tax rate of 21%, we have an additional tax liability of $105,000. So this is going to clearly make an impact more for some businesses than others. So let's talk through a few examples real quick. So if we have company A, who, let's say their sales didn't decrease a whole lot, they didn't have to lay off too many people, but they needed PPP proceeds to continue paying their employees. So when they received PPP loan and they paid their employees, the expenses that are now paid with the PPP proceeds are not going to be deductible for tax purposes. Whether they had the PPP proceeds or not, theoretically they would have still been paying these payroll costs and other expenses, but those are now going to affect their bottom line. If we look at another company, maybe they were largely impacted and they've not been able to keep up sales, and so they had to lay off a lot of employees. So when they received the PPP proceeds, those payroll expenses and other expenses, they were able to bring employees back, and they were able to pay for those employees. So now that they received the funds and the expenses aren't deductible, they weren't necessarily expecting those expenses to be deductible anyway. At the current rate, maybe they weren't expecting to have payroll expenses because they didn't have any employees working at the time. And then for other companies, they'll be somewhere in between. So maybe they had to make a decent chunk of layoffs, but not everywhere. So it's going to impact their bottom line still one way or the other. It's important to look at our cash flow projections to plan for tax payments through the end of the year for our 2020 tax returns. And keep in mind too that maybe it doesn't make sense for the entire PPP loan to be forgiven, and maybe it would make more sense for cash flow purposes to retain some of those funds and pay them back over the next couple years at 1% interest.
Rebecca, thank you very much for that. And I think the pushback that's happened, and I think you alluded to it, and I think you said it much more eloquently than I've had the conversation, not on webinars, but maybe it is fair and equitable that if we receive tax-free money, we shouldn't get a tax deduction. We're not going to debate that today because I know there's two sides to that. The cause for concern here is that for basically a month, companies and businesses were operating under one set of rules related to tax deductibility, and then overnight it completely changed on them. So hopefully that changes if Congress gets their way to kind of revert back to what the CARES Act was. But to Rebecca's point, in all of our cash flow modeling, we do kind of have to play under the new rules, and we should take that into account in our tax cash flow projections for the remainder of the year. So one of the next topics, I'm going to ask my colleague Chad to weigh in a little bit. We've gotten a lot of questions about audits related to PPP loans. Will the SBA audit me? What are the repercussions if I am audited and they call me on something? It's a pretty broad topic. So Chad, could you kind of talk us through this audit process, who could or couldn't get audited, and what it means for folks?
Sure, Dave. So when the companies applied for the application, there was a good faith certification that a lot of clients and companies were kind of uncertain what that exactly meant. About 2 weeks ago on May 13th, the Treasury issued some further guidance on how the SBA will review borrowers' required good faith certification concerning the necessity of the loan request. And basically it depends on the size of the loan. There's a $2 million threshold. So any borrower together with their affiliates that receive PPP loans of less than $2 million have deemed to be made the required certification concerning the necessity of the loan request in good faith. So this provides certainty for companies that received, or borrowers that received less than $2 million, that it was deemed necessary to support their ongoing operations. So we kind of conclude that this means recipients of the loans of $2 million do not need to return the loans because of the certification. And as Paul had pointed out, this does not mean that they could not be subject to an audit by the SBA. So we still recommend documenting your files properly, which I'll discuss here shortly. For borrowers over $2 million, they will have to provide an adequate basis for their certification. So it's certainly like a guaranteed audit for loans over the $2 million threshold. So again, documentation will be key not only for the necessity of the loan, but what you'll need to submit with the application, as Paul pointed out on page 10 when he was covering the application on his slides. Some of the analysis and documentation that we have been suggesting to companies could be some projections of various scenarios of what the business will look like in several months, demonstrating that without the funds that they may have had to lay off employees or may have not been able to pay certain expenses. Other projections could show if you did not lay off employees, that without the funds you may have had to dip into your line of credit, other cash reserves, or tap into resources that were to support your ongoing operations for the longer term. If you can show evidence of uncertainty of cash flow, which Dan Mudd will cover here shortly, such as accounts receivable, collection issues, or any type of correspondence from clients, customers, or vendors about changes in projects, payment cycles, or terms, and then any evidence of the difficulty in hiring workers resulting in increased labor costs, such as the retention or signing bonuses that were previously discussed. Also, again, it's important to keep detailed records of all the qualified expenses. These included canceled checks, payment receipts, payroll reports, copies of leases, copies of utility bills, include bills prior to February 15th, 2020 that will show that the service were established before that date, and then any documentation detailing your business rationale for any changes in pay rates, retention, or hiring bonuses. So again, putting this memo together, papering your file with all these supporting documents or projections, I think our overall message is be audit ready no matter the size of the loan. Certainly there's unanswered questions and there'll be more information to come. In fact, last week, the HEROES Act was passed by the House, but gained no traction in the Senate. But then late last week, they peeled out some of the real significant changes to the PPP loan, and they're expected to vote on this as a separate act this week, is the Paycheck Protection Program Flexibility Act. And if implemented, some of the proposed changes to the program are to allow forgiveness for expenses beyond the 8-week covered period, eliminate restrictions limiting non-payroll expenses to 25% of the loan proceeds, eliminate restrictions that limit loan terms to 2 years, ensure full access to payroll deferment for businesses that take the PPP loans, and extend the rehiring deadline to offset the enhanced unemployment insurance. So stay tuned. We'll, of course, be continuing to monitor this additional legislative changes and updates as they come available, and how it could affect you, but I'll now turn it back over to Dave.
Thank you, Chad. And I think the last part of your slide, I mean, the audit discussion is key for so many folks, just because that's a big area of concern. But I think the last point you mentioned related to some of those changes that could be coming to the PPP program, especially the 8-week window, if that gets extended, could be key for folks. So you can definitely have my word personally, and our word as a firm, that we're going to let all of you know as soon as we get more word if something passes and what it's really going to mean to the program. I know we're getting really close to end of time here. I do want to hand it back to Dan Mudd real quick, just because a lot of what we talked today is in different ways, shapes, and forms, all about cash flow forecasting for your business. So Dan, can you give us just a minute or two real quick on kind of the way you're thinking about cash flow planning and cash flow related to the COVID crisis and the PPP loans?
Thanks, Dave. Yeah, I mean, a lot of businesses do run their company on cash flow, maybe looking at it daily or weekly, but nobody's ever been through a period like this before, ever. So I think it does cause everybody to think outside the box. We've been consulting with our clients, telling them to look at short-term and long-term cash flow projections and planning. Short-term in my mind is 2 weeks. Long-term in my mind is no more than 3 months. Just once you go out past 3 months, there's too many variables, and you're guessing at that point. But to know what to do during your 8-week period and to know what to do with your PPP loan proceeds, you really do need to look at your short-term and long-term cash flow projections. And you kind of plan for Worst case scenario, best case scenario, knowing that you're going to come in the middle somewhere and that you're just trying to plan ahead. And that just flows right into what happens after my 8-week period. I mean, if you are so focused on maximizing your loan forgiveness and you do use all your proceeds during the 8-week period on payroll and other things, and then your business fails after 8 weeks, well, that really wasn't a good use of that money. So you do need to look beyond your 8-week period. You are opening back up. You got to have some type of plan in place to make it past 8 weeks, to make it to your end. So with that in mind, just while we all know small businesses have used cash flow in some of their planning, I think it's time to ramp that up. And if you've never done it, it's time to start doing it for sure. And then I guess lastly, we have a really nice blog on our website on 10 tips for cash flow planning in a crisis. One of them is on cash flow projections. Just to mention a couple: monitoring your receivables, looking at your payment terms with some of your vendors, adjusting your inventory levels and staffing, and reviewing all your costs. So that's on our website. It's a really nice blog, and it's about 2 pages. So I encourage you to go to the website and check that out.
Thanks, Dan. And yeah, this time is no different than any other, but even more critical than before. Cash flow forecasting for businesses is just extremely critical right now. So if you haven't started putting pen to paper or using Excel or using whatever you want to use to really start looking out over the next couple weeks through the end of the year and into next year, we would highly encourage you to do so. So we are at time, but I've been watching this live Q&A, and we really appreciate all the questions. I did want to revisit one topic because it's something that did change with the loan forgiveness application, and we do want to make sure that we leave everybody super clear with. And since Dan Schindler has been our go-to in the loan forgiveness application, I'm going to bounce this one back to him. But Dan, can you please talk through this concept? The words paid and incurred are used a lot in the PPP loan program. Specifically, can you talk about how that impacts wages, and then how that impacts the other costs, so rent, utilities, and interest, looking at our 8 weeks?
Sure. If there was any confusion, we do want to provide some clarity here, and this is really surrounding the eligible payroll costs and eligible non-payroll costs during the covered period. The concept between the two is similar or the same, in that, you know, for non-payroll costs, the eligible non-payroll costs must either be paid during the covered period or incurred during the covered period but paid on or before the next regular billing date, even if that date is after the 8-week period. For example, if you had April rent that was due on April 1st, you didn't pay it on April 1st. You got your PPP loan on April 10th. You paid your April rent on April 10th when you got your PPP loan. The rent payment paid in that covered period is eligible for forgiveness, even though it was still due previously April 1st. Same concept with utilities, same concept with payroll. If you pay it at the day you get your PPP loan, or shortly after that, if you pay any eligible payroll or non-payroll cost during the covered period, even if it's for a period prior to the 8-week covered period, it is still eligible for forgiveness. Similarly, on the back end, if it is incurred during the 8-week covered period, but paid after the 8-week covered period, it is still eligible for loan forgiveness. Hopefully that cleared that up.
Dan, thank you for that. And that's, if you've learned nothing more today, it's that there are so many dates, so many different periods. So just make sure, taking good notes today, or follow up with, we'll show the last slide here. If you could jump all the way ahead to the contact information, but definitely always feel free to reach out to one of us on the program today if you have follow-up questions. We are going to post the questions that were answered today. We'll get those polished up a little bit, and we'll get them posted to our website. Again, we are going to share this recording with all of you. It usually takes a couple hours to get it all put together in a nice format, but we're going to send that out today as well. It will also reside on our website. So went a few minutes over, but I really thought it was important that we revisit that last topic, since it is such a quite frankly, such a confusing area, but we wanted to make sure we cover that again. So as I opened it up, we really do appreciate all of you joining us today. It's our pleasure to have you with us. It's my pleasure to host all of you. Feel free to always visit our COVID-19 Resource Center. We're adding things out there daily, sometimes multiple times daily. So it's out there as a resource for all of you. So again, thank you all. I hope you enjoy the rest of your day, and be safe out there.